this is Claudia here from the Bookkeeping Expert. I am back for more with one more tutorial on QuickBooks Online. Today, we're going to talk first of all about wellness. As an accountant, as a bookkeeper, it is very easy just to work hours and hours sitting down without exercising, and at the end of the tax season, you're completely worn out, and a lot of times, getting sick, like myself. I actually did get sick. So what did I do? First thing is make some changes. Make sure you get enough rest. Make sure you plan your day so you can have enough time to exercise. Or like I did, I got a standing desk. So sometimes I go up and down. And so this way I can exercise a little bit while I'm meeting with clients or doing some work. And when I get tired, I can sit down and move a little bit. And I also set an alarm clock. Every once in a while, I have to stop everything, just go on a walk. Make sure I exercise. Is so important. So important for business owners as well. You got to take care of yourself. There's no healthy business if you, who is the heart of your business, is not doing well, right? So fill your cup a little bit. You're running on the low, so make sure you fill your cup so you can feel good and be able to do your very best. We also talk about the wellness of your business. How do you know if your business is good or not? Is to be able to access and evaluate if everything is being recorded correctly. Today, we are going to talk about a very important subject. All right, and it's journal entries. How do I do journal entries? Why do I do journal entries? Well, first of all, why do I do journal entries? I do it for adjustments at the end of the year, and sometimes there are discrepancies, especially like with integration, like QuickBooks Online and so on and so forth, that at the end of the day, you need to do some adjustments because of integration issues, right? So we have several videos on integration and how to fix them, but even with everything running pretty smoothly, at the end of the day, you probably will need to do some adjustments, especially on the fees, gift card, and things like that to make sure everything is accounted for. All right, so yes, that's why journal entry is very useful. Now, be careful just to use journal entry, because journal entry is something you do at the end of the day. It means after everything else is done. Remember, there's a workflow for QuickBooks for business owners and for bookkeepers. So the first thing you want to do at the beginning of the month is categorize all the transactions, categorize everything correctly, make sure that transfer will be matched on the other side, and that your sales that has sales receipt or whatever it's matched correctly. So anyhow, categorize everything, match everything that needs to be matched. After that is reconciliation. You want to reconcile all your accounts. Reconcile your bank accounts first. Those are the most important. Then second, all your credit cards. That's the second most important. And then reconcile all your loans, all your mortgage, everything. Make sure that everything's accounted for. It means that if you're paying on a car payment, of course, the total payment of the car is not all for the principal. It's split up. We talked about that last week. Remember, split up. So some of it goes to principal, some of it goes to interest expense. Interest expense is deductible, and then the payment to the car that actually goes to deduct your liability, right? So finally, after you do all this, you reconcile everything. It's done. Is done. You can take a look at your reports and see if there is any discrepancy there. At that point, when you know that everything is reconciled, everything is good to go, that's when you do a journal entry. Now, you don't want to do a journal entry for there are some certain things you never do journal entries, and there is undeposited funds. You never do a journal entry to clear undeposited funds, because that's just going to create a mess. you want to fix that. You want to be able to fix that, and we have video on how to fix undeposited funds. All right. In other accounts as well, especially if there is duplication, you want to make sure that you fix the duplication while you reconcile the account. Remember, you fix all those issues. That's why you reconcile. If the button on the reconciliation on the very top is not checked, the check box over there on the very top means that your account is not reconciled. If there is still transactions sitting in there, it's because those transactions need to be addressed. Now, if those transactions are clearing the following month, then it's okay. But if it is just duplicated, or just whatever it is, you need to clear that. That's why you reconcile. But anyhow, so journal entry is mostly to do those adjustments that you can't fix, right? So we're going to talk about that. Let's go to QuickBooks Online. Okay, let me maximize here. Okay, we're going to talk about e-commerce, by the way, pretty soon. How to connect Shopify, Amazon, and eBay. Few tips. Shopify, for instance, does not work. Oh, the Shopify integration with QuickBooks. There's other integrations out there, but the one with QuickBooks does not bring any cash transactions, so that you know. A little tip here. All right, so let's talk about journal entry. To do a journal entry, you want to click on the plus new. This plus new is where all your transactions are going to be located. So journal entry is right here. Okay, and journal entry has two sides of the transactions. There's always two accounts. There's a debit and there's a credit, right? So, for instance, when you purchase, let's say, an office desk under $2,500, so it's an expense. So you're gonna, first of all, you're going to debit the expense, so you can record the expense, and then you're gonna credit whatever account you use to pay for that, right? So you're diminishing the money on your bank account. Or, for instance, let's suppose that you purchase this with a personal card and you can't just record on your bank account. So what do? You record into an owner's investment account. So you're gonna debit the expense and credit that equity account, such as owner's investment or owner's equity, right? So there's always two sides of the coin, and both of them needs to balance each other. So whatever is in debit needs to match credit. So debits and credit need to be the same. It's kind of like a T account. So whatever is taken out of this side needs to be put on the other side, and so on and so forth. But it's much better. All right, so journal entries are mostly used at the end of the month to make adjustments to the account, right? Some of the adjustments that we may do, for instance, is if there is a discrepancy. Let's suppose Square, you're taking a look at the Square reports and you see that maybe the refunds are not reflecting correctly and your sales are off for that amount. So at the end of the month, you want to go ahead and record that discrepancy. So you want to do the date, the last day of the month that you're adjusting. And I'm going to say that there's discount given. And discount is an income account. But when I want to increase the discount giving, I'm going to debit that. So it's going to be a negative amount on the income. So it means it's going to diminish the income. So let's suppose that we're off by $650. Discount for whatever reason didn't show, and my counter account here is going to be my sales, because my sales did not reflect the discount, neither did it reflect the sale of the product. Okay, so I'm going to it's kind of interesting. This one is going to be kind of like even out. It's going to zero out that amount, but it's going to show me that there was discount giving. So increase the sales, but also showing that this is to reflect my discount, right? So it's always two sides of the coin. So let's suppose that, okay, so I'm on the description here. I'm going to write down what that is. So discount given to customers, and you can give it, and you can do it on both sides. Another account that we always adjust is going to be gift cards. Sometimes Square doesn't, or not just Square, but sometimes gift card doesn't flow correctly from whatever app integration you're using. And if you need to do adjustment, gift card is a liability account. In order to increase the liability or credit gift card outstanding, you need to credit that. So any kind of liability to increase, you're gonna credit it. It's kind of counterintuitive, right? Okay. Oh yeah, actually, so the debits for expenses and assets is going to increase, and credit for assets and expenses is gonna diminish when you credit that. So it's kind of a little confusing there. So assets and expenses increase when you debit it, okay? And liability and equity will increase when you credit it. So, all right, so let's make an example here. Gift cards, like I said. So let's suppose that I sold gift card. Well, this is a simple account, so we don't have gift cards. So I'm going to create the gift card account right from here. So like I said, it's a other current liability. Okay. And I'm going to call other current liability. We don't have gift card here. And I'm going to call gift card. Okay, now gift cards, they're not sales. So sometimes gift cards is recorded to sales, but they are not sales. It's a liability to your bank. You haven't earned the money yet, believe it or not, even if it is non-refundable. For a lot of the states, if the customer never redeems that, you have to pay it back to your state. So it's just a liability. You're holding on to money that you haven't earned, right? So let's suppose you sold $1,000 worth of gift card, but it was originally recorded into the sales account, but it's not sales. So what do I do here? How do I reverse that? So I'm going to credit gift card, which is a liability account. And it's going to increase it, and I'm going to decrease my sales by $1,000. Okay. So by doing that, I will record the gift card liability, and at the same time, I am going to decrease my sales, because this is not sale. Gift card, not sale. Very important to know. Okay. So other things that I may use the journal entry for. Okay. Oh yes. In order to save that, you can go ahead and save and close or save and new. Okay. And then you got that transaction recorded in there. Now, keep in mind, if you're recording anything to a bank account, you want to make sure you match that. If not, you're duplicating everything. So you don't want to duplicate anything. Whenever you create a transaction that goes into your bank account, you want to make sure you match that. All right. So one more example is depreciation. Depreciation is definitely something that we need to use a journal entry. Now, how to depreciate, it depends on the asset, the life of the asset, and it depends if there is any kind of current promotion. As far as not promotion, current is not promotion, government promotion. Now, if there is any exception for the year as far as accelerated depreciation and things like that, talk to your CPA. Each state will have certain regulation as well. Talk to your CPA, but anything you purchase that is over $2,500, that is going to last more than a year, that is called a fixed asset, and it's not going to be expensed right away. It will be what we call capitalized, means depreciated over the year, so that expense is going to go, it's going to be broken down over the life of the asset. Okay, so at the end of each term, especially at the end of each year, you're going to depreciate that asset. So let's suppose you pay $10,000 for that asset, and that asset will last 10 years. So you want to depreciate maybe $1,000 per year, right? Or 100, not less than 100, or whatever amount is per month. So let's just do it at the end of the year, and I'm going to depreciate $1,000 at the end of the term. So first of all, I want to debit depreciation expense, right? And that's $1,000. And what happens with the depreciation? So it's going to lower the amount of my assets. So my assets is in the books are not worth $10,000 anymore. It's worth $9,000. That's the book value. Doesn't mean that that's how much that asset is worth. As it's not the price, the market price of the asset. It's just what we call the book price of the asset, whatever is in your books depreciated through the years, right? So what I'm gonna do here is take out of that asset. So I have the depreciation expense, and I'm gonna take out of the asset, which we're going to say, car. Let me see if there is any asset here. There you go. Truck. So I'm going to take out of that truck value, the fixed asset. So I'm going to credit that asset. When I credit the asset, I'm going to lower the value of that. So actually, we do have the depreciation, the truck depreciation account here. So let me go ahead and put the sub account of truck depreciation so that this can go to the right account. So if you do have the depreciation for the specific asset, you want to select the right one. So I am lowering the value, the book value of the truck in my books, and at the same time I'm recording that expense for the truck depreciation. So that's going to lower my book value of that asset and record the expense. Okay, so you can save and new and save and close, and this is going to record your yearly depreciation. So those are some of the journal entry. Another one that I made, another adjusting journal entry that I usually do at the end of each booking cycle would be, or the year would be, owner's distribution or owner's investment. Usually what I'm going to do at the end of the term, I'm going to zero out my owner's investment, and I'm going to put that value into retained earnings. The reason why I do that is so that I can calculate the following year. For some business owners, just leave it there so you can track it if it is investment. But if it is distribution, for instance, you want to track that distribution year by year. You want to clear that account out, and you're going to do that against your retained earnings. So those are all journal entries that you want to do at the end of the year, so you can zero those accounts out and then start tracking again on the following year. All right, so hopefully this was useful. Yay, I'm back here. Okay, back. Hopefully this was useful and helpful for you to understand what journal entries and how to use journal entries. Like I said, be careful when using journal entries. Journal entries can be a little tricky if you're trying to adjust balance, such as undeposited funds. You don't want to do that. There's the right way to fix it. Because if you just do a journal entry, that's going to be stuck on your temporary undeposited funds account, and you'll never be able to clear it out unless you undo that transaction. Okay, so important to know. If you have any question, just write down below. If you like this video, give us a thumbs up. Give us some love. Show us some of that you like it. Okay, but thanks for spending this time with me today. And I hope to see you again next week. I'll be back for more. Always back for more. Always back for more. But if you want us to cover a certain subject that you're struggling with, write down below. And we'll definitely cover that. We would love to cover that. I'll say yes. Please write down below. Subscribe to our channel so you can stay up to date with QuickBooks Online and what's going on and integrations and issues trying to get your books up to order. If you need any help getting your books up to date and you want to focus on what you do best and help us do what we do best, please contact us. Just contact us. There's our phone number, our website down below. Feel free to send us a message. We can do also a one-on-one tutorial where we can help you understand what's going on with your books or even help you clean up and educate you on how to do it right so you can continue keeping your books up to date and knowing exactly where you are, your point of reference, so you can grow your business and take it to the next level. All right, so thanks for spending this time with me, and I'll see you next week. But until next time, keep on smiling.